Yay. What is going on, guys? What is going on? So the last time that I tried this, it actually didn't go so well because I was in New York and the Airbnb that I was staying in didn't really have good internet. So I'm hoping that right now this upholds. So I'm using a dedicated hotspot. So hopefully the connection here holds. I tested it before and it was really good. So we're obviously here to talk about the rate hikes, and they're about to come out any minute now. Actually, they just came out. So the Fed hikes interest rates by 0.75%. That's 75 basis points. That's pretty much expected. I don't think that this was a surprise to anybody. I personally thought that there was a chance that they were going to do a 100 basis point rate hike. We're obviously waiting for the FOMC to start talking. They did schedule this for 11:30 a.m. Pacific time, 2:30 p.m. Eastern time. However, the decision comes out before the Fed actually talks, but we will keep monitoring this to see whether we actually, we're going to keep monitoring this to see whether the Fed actually comes out sooner than 2:30 p.m. Eastern time. But yeah, you guys let me know and I will turn the volume back on. Let's dive through this. So the Fed hikes interest rates by zero, and I'll get to your questions and your comments in a second. It's good to see you guys. I haven't been live for a while because, like I said, I was moving around and the internet wasn't stable enough to live stream. Right now, this seems stable enough to live stream, and I'm really excited, but you know, I'm not gonna be I'm not gonna rejoice too soon. I'm gonna let this thing play out and see how it goes. All right, so it says the Federal Reserve on Wednesday enacted its second consecutive 75 basis point rate hike as it seeks to tamp down runaway inflation. Now, remember the important thing, and if you guys are fans of this channel, you know this already. The important thing is that tomorrow is the GDP numbers. Excuse me. So because the GDP numbers are tomorrow, we don't officially know if we're in a recession or not, although based on how the White House has been scrambling to try to redefine what a recession is, to me, it seems like, you know, the numbers are pretty bad if they were trying to fight it that early. So I do think that we will officially be in a recession as of tomorrow. But the Fed did have the luxury of really announcing the rate hikes a day before, as opposed to waiting for the GDP. Because if the GDP announced that we're in a recession, then now the Fed sort of has a conundrum on its hands. Does it go into inflation fighting mode, which usually involves raising rates, or does it go into you know, economy saving mode, which involves either pausing or cutting? So it's really lucky, I guess, or a lucky coincidence for them that they announce the rate hikes a day before GDP and not after GDP. Especially since I think that we're going to be in a recession already, and I'm not the only one. So in taking the benchmark overnight borrowing rate up to a range of 2.25 to 2.5%, the moves in June and July represent the most stringent consecutive moves since the Fed began using the overnight funds rate as the principal tool of monetary policy in the early 1990s. So that's also probably why they didn't do a full percent rate hike, because it would have been already with 275 basis point rate hikes back to back. It already is the most stringent back to back rate hikes that you know that we've seen since the 1990s. Although I want to say the early 80s, we've seen worse, or I guess more strict back-to-back rate hikes. Let me see what the Fed is doing now. Still, Powell is not speaking. So yeah, I think they're going to go live 2:30 p.m. Eastern time, which is in about 25 minutes, and we'll cover it. Now, the one thing that is an anomaly here is, or I guess that people, the economists have been saying, or at least articles that I've been reading have been stating is an anomaly, is that the unemployment is really high. Unemployment is really low for a recession. However, we have this data here that details every single recession going back to World War II. And you can see that a ton of times unemployment is historically low for the time before a recession. We saw this in 1974. We saw this in 1980. We saw this in 1990. We saw this in the year 2000, 2001, and we saw this in 2008, and we are seeing this now. So all that would need to happen is we get an uptick in unemployment, and that usually, along with all the other things like the yield curve inversion, the back-to-back negative GDP quarters, etc., usually that puts us into a recession. So because there have been so many layoffs, and I'm sure you guys are seeing this from the earnings calls that have just come out, whether we're talking about Microsoft or some of the other companies, we're either seeing a freezing in hiring or actual layoffs. And those might contribute to the next unemployment numbers ticking up slightly, which would be on par with what usually goes on. So, this sort of talk that historically low unemployment is weird for us to be in a recession, that just does not align with the truth. We see this time and time again. So yeah, I'm not sure why article writers are saying that's an anomaly. Let me get to your questions. Oh, there's a ton of guys, a ton of people here. Okay, Ryan, Snowy, Mr. Think Possible, Anthony, Cesar, Hassan, Kevin, what's going on, guys? 75 basis points as expected. Yes, gonna be in Porto and Faro in 2 weeks. Doc, I won't be here. I'm actually leaving on Friday. Just do a live podcast. Switch off your camera. Why? It looks like the stream is excellent. Why would you be saying this, Doc? I don't think that it's bugging out. Is it? I don't think it is. It looks perfect to me. What's going on, Harry? What's going on, Munesh? Scotty G. Yes, guys, hit that thumbs up. Please do that so that other people find the stream, and it's helpful. Stream is great. Yeah, it looks like the stream is excellent. So thank you for confirming, Scotty G. Yee, what's going on, Richard, Dexter? What's going on, guys? What's going on, Shaft? What's going on, brother? How you been, man? Venus Frozen. Visa doesn't look good, says Nguyen. Yeah, I think that there was something that just came out talking about credit card defaults or credit card debt being too high, right? Do you feel Powell is doing what's best for the economy? I mean, this is a good question. I don't think that the Fed got out ahead of inflation. So no, I don't think they did what's good for the economy, as early as they could have. I think they could have started this in 2021, when coming out of the pandemic, we had some of the strongest GDP growth numbers. However, now I think he's doing what he can, of course, because now you're straddling the lines between trying to tamp down inflation and not throw us into a recession. So yeah, I do think that what he's doing now is what's necessary, but they definitely fucked it up, in 2021. They should have started raising rates in 2021, not 2022. How do you feel today, bro? Market is waiting. How do I feel about what? I've been updating you guys video after video. We had the mega cap earnings. We have the FOMC meeting, obviously, which, we just got the 75 basis point rate hike. We will be listening to what Jerome Powell has to say, because I think what the Fed does in September will be more important than what the Fed does now. I think the 75 to 100 was priced in. If you looked at the FOMC watch tool and the Fed funds future rate, the 75 basis point rate hike was priced in, 75 to 100. Either 75 or 100 would have been fine. Less than 75 or more than 100 would have been a bout of uncertainty, and the market doesn't like uncertainty. But we had the FOMC rate hikes, and then we have GDP tomorrow, which I think a mild recession is priced in, because everyone thinks we'll be in a recession, thanks to the White House also trying to get it ahead and try to redefine what a recession is. That already lets me know that we will most likely be in a recession. What wasn't priced in, and what still isn't priced in, is the bout of mega cap earnings. So we had Netflix. They missed on earnings but provided good guidance. And remember, the market has tanked so much since January. It's been a straight line down, really, that now what the market is looking for is, how do companies report guidance? they know that earnings will be bad, either due to a slowing down economy and or due to price instability and high prices, right? So what the market is looking for is how is, how is the how are the rest of the companies going to define their guidance? Are they going to give good guidance? Are they going to give bad guidance? And so they're willing to put aside negative earnings in lieu of good guidance. So Netflix reported positive guidance. Snap reported negative guidance, which is why it tanked. We had Tesla, it beat on earnings, missed on revenue, but provided good guidance as well. Microsoft missed slightly, provided good guidance. Google missed, provided okay guidance. It wasn't good enough in my view to justify the price hike, but it also rallied in sympathy with Microsoft. And then we have, Meta tonight, which is Facebook. And then we have Apple and Amazon left. And then on Friday, we have the oil companies, Chevron and ExxonMobil. So, that's what isn't priced in. But I think a mild recession is priced in. And I think obviously the FOMC was somewhat priced in as well. Now, what they do, how they talk about September, I think isn't priced in. So if the Fed says, hey, in September, we are, trying to decide whether we're going to pause or not. If they talk about any sort of pausing in September, I think the market will continue rallying. And personally, because it is an election year, right before the election, I do think that they will get pressure from politicians, Democratic politicians in this case, because that's the party that's trying to keep power. And both parties do this. So this is not a partisan thing. It's whoever's in power trying to maintain power will do whatever it can to give Americans sort of the appearance that the economy is doing well, right? So, even when Trump was president, he was pressuring Jerome Powell to stop raising rates. He even wanted negative rates, like in some parts of Europe. So both sides definitely pressure the Fed into trying to make decisions that will benefit their party. And in this case, I think that Democratic politicians will try to pressure Jerome Powell into halting or slowing down in September, because the elections are in November. And if that happens, the market will respond probably favorably to a slowdown in rate hikes. And that will give the appearance, if the market is doing well, that will give the appearance to Americans that the economy is doing well, even though the economy and the market are not the same thing. So hopefully all of that makes sense to you. Is now the start of a summer rally? It could be, Doc. It could be. If we get by Amazon and Apple earnings, it definitely could be. Now, I think, as I said, a mild recession is priced in. A deep recession is not priced in, but you won't know if it's going to be a deep recession until you're actually in it, right? That's the disadvantage there. But I do think if they announce a recession tomorrow, that is mostly priced in. Remember, the market actually goes up an average of 1% during every single recession, because by the time a recession is announced, usually the factors that leading up to the recession are already known. They are lagging indicators. So, that is usually when you hear the R word, that is usually the point at which you want to start loading up. So tomorrow, if they announce a recession, regardless of how the market reacts, I mean, that to me, that is the point to start loading up. I mean, I already started selling cash secure puts a long time ago, and we're up on those. But, I do think that you cannot not nibble on blue chip stocks here. You just can't, in my view. They're all down, 25 to 35%. So, yeah. Do you think it's a good idea to buy some put options today before the GDP comes out tomorrow? I don't think that, unless you're trying to gamble. I don't think it's a prudent trade unless you're trying to gamble. Thank you very much for all your updates. My wife and I really appreciate it. Thank you, J. Manuel Huerta. And welcome to the stream. And yes, guys, hit that thumbs up, please, so that other people can find the stream. And again, we will be going over Jerome Powell's comments here. We're just waiting for them to go live. 2:30 p.m. Eastern time is when they're going to go. So, Yeah, and let's take a look at this update here. Let me get back to your questions, and then I'll take a look at that update that came in on CNBC. Thanks for all the info. Appreciate the videos. Appreciate you, Ricardo. What do you think isn't priced in? Says Manny. I already mentioned it. Bullish Z. I gave you my take. It's not as simple as bullish, but yeah, I gave you my take. Let's say the numbers indicate we're in a recession. Does that significantly change investor sentiment? Hasn't the market priced in a recession? Yeah, I already talked about this, Andrew. Maybe you sent that before I did. But the market is priced in my view, at least the announcement that we're in a recession or a mild recession, right? So I think the market is pricing in minus 1.6% because that is what the Federal Reserve of Atlanta has already told us their tracker is looking like. But if we say get a deep reading for July's for Q2 numbers, and it says that, you know, we're -2 or -3%, I don't think that that is priced in. And certainly an extended recession, meaning, you know, one that lasts a long time, isn't priced in. But again, you won't know that until we're actually in it. But yeah, it's totally confusing. But when a big company misses and goes up, that's very bullish. It's not confusing because remember, Tom, that earnings are only one tiny part of the equation. Guidance is the other. Guidance is very important, especially during a market in which you know, everything has tanked. When everything has tanked, you get what is called multiples compression or earnings compression, right? Meaning that the market will reprice these stocks based on what is going on. And so we usually, when stock in a bull market, stocks trade at high multiples. But you know, when the economy is slowing down and when these multiples get too high, then the market reprices these stocks, and that's why stock values go down to lower multiples. And then you also have something called earnings compression, where, you know, companies have missed on. Remember the last earnings season, right? Companies were missing all across the board. You had Facebook, Netflix. I mean, look at Meta and Netflix. Both of those. Netflix was trading above 600. Meta was trading at almost 400, right? Like those stocks are blue chip stocks that have just taken an absolute beating. So at some point they get repriced so low that really all the market cares about now is guidance, because it already punished those stocks for missing earnings and it punished those stocks multiples. So remember that earnings is just one side of the equation, guidance is the other. So right now, what the market is looking for mostly is guidance. And so when Microsoft gives good guidance, or Netflix gives good guidance, or Tesla does, you tend to see those stocks go up slightly, or at least not tank, even if they missed on earnings like Netflix did. Tesla missed on revenue. Microsoft missed slightly, right? I think they missed on, did they miss on both? Okay, so Microsoft missed on revenue and income. Okay, yeah. All right, let me go here. So here's what changed the new Fed statement. This is a comparison of Wednesday's FOMC statement with the one issued after the Fed's previous policymaking meeting on June 15th. Okay, it wants us to actually click in this and look. I mean, this is tiny. I don't know if I'm going to do this on the stream. Let's see. This is such a wonky, okay, not important. Let us see if Jerome Powell is talking. No, he's not. All right, what is the market doing actually now? Let's see. Now that the Fed has announced what they announced, let's see what they're doing. And by the way, you know, whether the market looks at this as positive or negative, we won't really know until a few days, a day or two later. In my view, again, that is priced in, so I don't think we will see a massive drop unless, you know, they talk about September and still talk aggressively about September. But in my view, I don't think, you know, the 75 basis point rate hike is going to have much of an effect. However, we'll see when Jerome Powell starts talking, if, you know, he starts talking about September as very aggressive, as a very aggressive rate hike period, how the market will react to that. But, we have seen delayed reactions a day or two after. So, I wouldn't take today as the end all be all of how the market reacts. If the Fed actually does give more info in the FOMC meeting, if all the Fed says is, hey, we're raising 75 basis points and that's it, then I think the market will continue to look at that as priced in and look forward to the rest of the earnings today and tomorrow. So so far the markets are pretty much where they were before. 2.5 up for the Nasdaq, 1.4 up for the S&P, 0.4 up for the Dow. And yeah, I mean, for those of you that are fans of this channel, you know that I drew this pattern before, showing a possible fractal with the last round of earnings that we see here, where we have this sort of I guess Adam and Eve looking pattern, right? A smaller triangle and a bigger triangle, or a bigger rounding bottom. And it looks exactly the same here. I drew this maybe 2 weeks ago, saying that if we get good earnings, the S&P 500 can flirt with the 4,000, 4,100 level before deciding whether to keep rallying or not, depending on what is going on with the economic factors. But yeah, we could definitely get to the 4,100 level during this mini bull run if earnings continue to be good and the GDP doesn't come much worse than minus 1.6%. So all right, let me get to your questions. If you guys have any questions or you want me to look at any charts before Papa Powell starts speaking, let me know. Would be happy to do it. If you want me to answer any questions about options, strategies, options trades, technical analysis. If you want me to answer any of this stuff is an open forum. I do this stuff for you guys. So ask me here and I will be happy to do that. All right, business as usual, says not Enrique. Yes, you're right. You think the market bottomed out yet? Raj, depends on the time frame you're talking about. Yeah, it could have bottomed out for the time being. Obviously, again, we don't know whether we will get a deep recession or not. If you talk to someone like Michael Burry, he thinks we're actually halfway there, because he thinks that, we could get to a point where the inventory bloat from retail deepens the recession even more. So you can look at, if you Google Michael Burry bullwhip effect, you could see this. And I can get into that if you want. Bearish until the rate hikes stop. That's my thoughts. Yeah, kind of, Alvin, although we do have data that shows that at some point the market starts pricing in these rate hikes and the market actually goes up during rate hikes. So yeah. Wrong. There will be much pain with all the back and forth fighting from both sides. It will get ugly. Are you talking about politics? I don't know. Rakesh, love you, man. Started following you. Love you too. Expect people going out on the streets and rioting? Okay. I don't know what country you live in, Samuel, or why you think that will happen, but yeah. Everyone's entitled to their own opinion, I guess. Printed Z, save as PDF. Oh, you're talking about the thing? The FOMC statement. Yeah, I don't care that much because it's not the central focus for today. And plus, we're going to hear Jerome Powell talk in 7 minutes here. So is it smart to sell the QQQ until Friday for a potential drop tomorrow after the R announcement? I mean, that sounds like you're trying to time the market day by day. That's never going to happen for you. Sorry to tell you that. Is it watched El Clasico? I saw the highlights. How does all of this affect bonds TLT? TLT will likely, I did a video talking about the correlation between real rates going up and between bond yields going down, which means that TLT will go up. So the more that real rates continue to go up, the more that bond yields will continue to go down, the more that TLT will continue to go up, but it's going to be bumpy. What's going on with the bond market is that, people are pouring in and out of the bond market for a few reasons. And you can see here a head and shoulders on the 10-year yield. But basically, when folks are afraid of inflation, they start selling bonds, which raises the yields. when folks are afraid of a recession, they start buying bonds, which lowers the yield. So you see this price action going on really since April, where bond traders or bond investors are selling bonds out of fear of inflation, and then they get high, they start buying back in, and then they start selling bonds again out of fear of inflation. And these usually coincide with CPI releases as well. And then they start, buying bonds because of fears of a recession, and also because the yields get too high and too juicy to pass up. And you can see this going over and over and over again. So we have this head and shoulders here on the 10-year Treasury yield. But yeah, when real rates go up, the Treasury yields actually go down, which means that TLT does tend to rise. Please look at RH. I want to buy calls. I think the recession is going to bring them down a little bit more. So why would you buy calls? I'm not sure. Why would you buy calls if you think it's going to go down? One word, stagflation. Yeah, we could be in a stagflationary environment. Stagflation is when you have rising prices or price instability, but the economy is stagnant. That's very possible as well. Yes, for sure. Wow, I'm really surprised at how great the stream quality is. I'm so surprised. Like, I'm literally running this off of a wireless hotspot that I bought earlier today. This is just, running off of a SIM card. And this is way better than the Wi-Fi that I had at the Airbnb in New York. When does Powell speak? In 3 minutes. And your name is Z2? Wow, interesting. How to play the VIX. Well, yesterday we bought VIX calls and they were up 30%. You could have closed those. In my view, I wanted to keep VIX calls open for the rest of the week, really just for a hedge. I could have closed them if I was looking for a quick trade. And some people did close them. Some people in the Traveling Trader Academy did close them. But yeah, I mean, in this case, if you're expecting volatility to go up, then you buy VIX calls. But I wouldn't buy short dated VIX calls. I would buy them at least, a week or 2 weeks out. So yeah. What's your take on Tesla? I don't know what you mean, Caesar. Be a little bit more specific. Puts or calls, Rakesh. I don't know what stock you're talking about, man. Do you think Google will go up? Yes, Google has gone up, and I do think that, it was probably a smart deal to buy Google 30% down. I sold cash secure puts on Google as well, but yeah, I mean, I do think 30% off. How can you surpass a company that is literally reporting $70 billion in quarterly revenue? That's insane. So home builder stocks get hit with the rate hikes. I mean, I think Josue, that plays a little bit late. For the home builders, I think there was a really lucrative time to buy that, to bet that home builders are going to go down. But yeah. Hey, any thoughts on buying VIX calls as a trade with a 1 week horizon at Aditya? Yes, I do think it's a hedge. I don't think it's a guaranteed winner, but I do think it's a good hedge. Should we buy some UVIXI? I don't like UVIXI. I trade the VIX directly. Do you think Papa Powell will ever admit how bad things are? He always admits it. I mean, he always admits it from his purview or from the data that they have responsibility over. Yeah. It's not his responsibility to talk about a recession, by the way, if that's what you're thinking. Should short call Tesla? Should short call Tesla? I don't know what that means. Don't jinx the stream quality. Amir. I love you more than yesterday. Thank you, CAO family. Why hasn't the stock market dropping yet? Why would it drop, Johnny? Are you patient enough with some fuckery comments? I got time to mess with you. I don't know if you're in the mood. Well, I am about to let Papa Powell speak, so your comments will likely get ignored. Tesla going up, why it's not down yet? Why would Tesla go down, Rakesh? I don't understand why you think Tesla will go down. It actually gave really good guidance. Do you think Tesla will continue going up? I think it will be volatile over the long term. I think it will keep going up. Yeah. Cesar, it's up almost 15% from last week. Yeah, they reported earnings last week, man. Where are you? Tesla reported earnings last week. They beat earnings, missed on revenue, gave really good guidance. Why do you want it to go down? Every time the Fed talks, stock market crash. Only for a little bit, actually, not for a lot. I have this data for you here that shows that the first few minutes, the stock market does drop. It says you can see the initial drop occurred right after the 2 p.m. Eastern time rate decision all 3 times, but then stocks rallied hard for the remainder of the day once Powell's press conference began. So you're actually probably better off buying calls if you wanted to really gamble here. All right, let's listen in, guys.
My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks.
I want to see what he says about the balance sheet specifically, because that's something that's not known.
If you
Walk
can
us
walk
through
us
your
through your
thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting.
I wonder if anyone's going to ask him about recession. I hope they do, because I want to see what his thoughts are on if we're officially in a recession or not.
And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
That's interesting. So he's saying that the Fed is not going to telegraph as much as they were up to this point.
Chair Powell, you've said that your policy works through influencing expectations.
I also hate
and
this
that
guy.
policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina.
Hi, Jerome. Thanks for taking our questions. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but
By the way, for those of you that are in the academy and bought the day trades, the calls,
are we confident that inflation?
those are in the money right now, and those things are going absolutely insane. Shout out to all the analysts in the academy as well, Kirsten, Flox, myself.
Ultimately,
I mean, those calls are going nuts right now.
Moving down to 2%. So you would,
And that's why I keep checking my phone.
of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point?
This is why Steve Leisman is a boss.
Contraction of the economy, the committee would be willing to abide in its effort to reduce inflation.
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. we think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, you know, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I mean, I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
This is clearly government influence to me. Like, you could tell. Jerome Powell is one of the smartest economists
I wanted to ask about
we have working in the public space.
Some senators
and
have written asking
you could tell that
the
this
rules
is
to have
influence.
more
This
teeth
is
and to have
completely
sort of more
government influence here,
transparency
where
about Fed's
they were
Fed officials'
told not to talk
financial
about a
activity.
recession.
I was wondering if you
They were
could
told
speak
to
that, whether
probably
you would
deny a
think
recession, talk about how
interpreting those
GDP
rules
readings are outdated or
So
not
those
really
are
as
the toughest
relevant.
rules in
It's
place,
crazy.
At any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really created a very strong and robust set of rules that will support public trust in the institution, and again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katarina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for making the
25.
decision on how much to raise rates, and just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris Rugaber at Associated Press. I wanted to ask about, right now there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation.
The PCE comes out on Friday, by the way.
And I think
it's the one he's talking about.
Understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end-of-the-year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second. As I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending.
Let me know if you guys want me to stop this and give my commentary on what he said so far.
People
I think the important questions have been asked, but let me know. Or if you want to hear him keep talking, let me know.
In terms of the overall direction of the economy. Not true of the second quarter. But at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times, and it usually.
All right, so most of you are asking me to comment. So okay, good. Here's what he basically said. Obviously, 75 basis point rate hike. That is the largest back-to-back rate hike since the early 90s. He did acknowledge that. He said in terms of letting the balance sheet run off, they're not changing anything just yet, but obviously they will look at it in September. He said he's not ruling out another aggressive rate hike in September, but he doesn't know just yet. But he also did say that the Fed will stop telegraphing the way that they used to telegraph up until this point. He said going forward, the Fed is going to basically keep their mouth shut until the actual Fed meeting happens, the FOMC meeting happens. Whether that will happen, who knows? You should lower your mic gain. Does anyone else think that? If ever anyone else thinks that, let me know. So there's you just disrupted my train of thought. But yeah, but that basically that come September and all FOMC meetings going forward, they're not going to telegraph as much. So that's basically what he said. Now, Steve Leisman asked him about the recession, and he completely danced around it. And I'm not talked about the recession, but in a muted way. He didn't even mention the recession. He started talking about jobs and how jobs are distributed among different genders and races, which obviously is important data to have. However, it has nothing to do with a recession, and it has nothing to do with Steve Leisman's question. Steve then followed up again and said, do you think we are in a recession? Yes or no? And how will that affect your policy? He still didn't answer it until another reporter right after Steve said, Chairman, do you think we are in a recession? And he said no. And when he said no, I mean, if you look at his body language, he was basically looking down. You could tell that, there's definitely government influence to avoid the R word, to avoid the recession. And then he went on to say the same thing as the White House chief of staff or as Janet Yellen, saying that, GDP, the way that GDP is calculated is complex and it's outdated. He didn't use the word outdated like they did, but he was saying that it's complex and it's not a real reading of, where we are in the economy. And how could you be in a recession if we added 2.5 million jobs in the beginning of the year and we're at record low unemployment? But check this out. I brought this up in my last video and I'm bringing this up now. We are almost always at record low unemployment right before a recession. Look at 2007, 2008. Look at this bottom that we hit here in unemployment. Look at the year 2000, almost the lowest unemployment to date right before the recession. Look at the year 1990. For that time, record low unemployment right before a recession. Look at 1979, same thing. Look at 1973, look at 1969. These are all right before recessions. So you could absolutely see record low unemployment before a recession. So that is not, I don't understand why article writers and the Fed themselves are talking about record low unemployment when, you tend to get this all the time. Adriel Roman, people, shut the fuck up, let Z talk. Facts, Z, can't finesse the public. Yes, Z looking way too serious, should we be scared? A lot of you are saying I look serious or tired. It may be the lighting in here. Also, I'm in Portugal, so it is, it's 8 p.m. here. Very different from where you guys are if most of you are in the US. Now, what does this mean for stocks? Like I said, I drew this weeks ago. I said we could see this pattern if earnings come in better than expected. And we're seeing guidance from Netflix, we're seeing guidance from Tesla, guidance from Microsoft, and guidance from Google so far being good. Now, obviously, companies can change their guidance, as we saw midway, like with Walmart the other day, changing their guidance and their stock price tanked. So guidance isn't the end all be all. Guidance just means that, you know, the next earnings season, if they don't live up to their guidance, they will be thrashed. But in the midterm, or in the short to midterm, we could see 4,100 on the S&P 500, especially if the GDP reading tomorrow comes out as expected, which in my view, I think a mild recession is priced in. Look, the market doesn't tank 30%, you know, for no reason. So all of this is, you know, fears of inflation, fears of a slowed down economy, fears of a recession. All of this starts getting priced in as the data comes out. So, you know, if you and I know about it and your grandmother knows about it, then the market knows about it as well. And I think the market is expecting a minus 1.6% GDP reading, a recession. You know, if it's more severe than that, we could get a market drop. However, remember that we still have Meta, Amazon, and Apple reporting earnings, and we have Chevron and ExxonMobil on Friday, although less important than those three that I brought up. So if those give good guidance, 4,100 is easily in the cards for the S&P 500, and we will complete this fractal just like we did in March, right? This is the same thing that happened last earnings season. And then going forward, depending on what happens with the economy, we could see another drop, another slowdown. If there isn't really anything severe, if in September the Fed decides not to be aggressive, the market can keep ripping, and we could, you know, continue. We could actually see a bull market coming out of this bear market. But I do think that if those three companies report good guidance, and we don't get something more severe than a minus 1.6% GDP, then we could see 4,100 easily. That is the next technical level for sure. For sure. And I was checking this on the call because I was looking at what the analysts were sending in the Discord. Shout out to Kirsten. Buying the 305 call. When did you buy this? An hour ago? Wow, netting almost double on this play. Buying it at 93 cents. Cutting it at $1.75. What a boss play. And obviously we have the day trade watch list from the morning. You know, and I bought these 300 calls in the queues and the 400 calls on the SPY. So that's why I was checking my phone during the stream. But yeah, I mean, if you guys have any questions about what I just said, let me know. Metaverse is dead, sure, but I mean, Metaverse could be dead, but Facebook is still one of the biggest advertising companies in the world, only second to Google. So, global thermonuclear war. I mean, this is the type of stuff that really is, while obviously could happen in some form of the universe, it doesn't really. You can't really predict this stuff, and is not worth betting on, because just like Art Cashin said, if you're betting on end of the world scenarios, then who the hell are you going to settle with? So, you know, fuck the market at that point. All right, let's see. So you're bullish short term. I mean, I talked about this weeks ago, Tark. I talked about this weeks ago, and please listen to what I'm saying. I'm not saying it's dependent, right? Like if Apple and Amazon come out and they say, oh, our guidance sucks, we're not going to hit these numbers that Wall Street expects us to hit. We missed earnings. We missed revenue. Our margins are cut short. Then yeah, I mean, obviously this bull rally is going to stall, right? So there you go. Hey Z, do you have a day trading course? Yes, there's a day trading course. If you want access to that as well as the options course, you can click the link in the description if you like. You keep your Iron Condor dates for Microsoft. The dates, yes, but I will likely adjust the strikes. But the dates will stay. All right, let's see. Your prediction on the market based on what he said. I just told you Powell is a professional dancer. Sure. Gain is good. All right. Anything relevant to the markets? I think rate hikes will slow or reverse course if economic conditions get worse. Yeah, that's actually what Michael Burry said. He said there could be, a chance at which the Fed actually stops raising, cuts rates by the end of the year. You've got to just, now it's your turn, blah, blah. All right, let's see. Tide gonna squeeze after hours. Doom boys are the new moon boys. Huh. Do you think we're a possible bottom? Oh my God. Like, how many times do I have to answer this? Guys, it's like you're not listening to what I'm saying. I've answered this like in 10 different ways. What's the difference between the day trading course and the options course? The options course teaches you how to trade options, and every option strategy is in there. The day trading course is specific to day trading. Just because you know how to trade options doesn't mean you know how to day trade. So how can there be a recession tomorrow when the 10-year 3-month, which inverted before every single recession, didn't invert yet? Why would it have to? I mean, just because it happened every other time doesn't mean it has to before this time. It can definitely be a recession tomorrow. Any chances of market flip down? I don't know what that means, Rakesh. Market flip down? I've never heard of this term. So if GDP comes in over 2%, the markets will crash. Likely so. Not over 2%, minus 2%. If GDP comes in over 2%, the markets will make new highs tomorrow. If you're a true teacher, you can repeat I've been repeating it time and time again. I don't know what way, how many more ways do you want me to repeat it? Larry Williams said market bottom was June 17th. Very close, although very close. And it was likely due to this technical pattern. But again, market bottom for when though? Right? Quit complaining. Wayne, not sure what you were on, brother. Not sure what you were on. What I said was, again, we have major mega caps left to report. If they report good guidance, earnings are, I think it's shown that earnings themselves are not the picture that the market cares about the most. The market cares about guidance. If they report good guidance, then the market will continue ripping, likely to 4,100, as long as GDP doesn't come in at, severely over minus 1.6%. That's what I said. So, do gaps always get filled? I read a statistic that said 95% of all gaps get filled. Yeah. Do you think the market will retract tomorrow? I already answered this. What do you get when you cross an elephant with a rhinoceros? Elephant. Green today, blood tomorrow. It depends on the GDP reading, Cyan. I mean, what if what do you call it? What if Meta reports good guidance, right? And then what if tomorrow the GDP comes in better than minus 1.6%? Then you will see, likely you will see that the market continue ripping, right? Of course, Larry will say that after June 17th, long past. He has been pretty good. Larry Williams is one of the best at technical readings for sure. What is expected GDP for green market? Rakesh, sometimes I think you guys do this on purpose, but whatever. I love you anyway. Minus 1.6%. How many ways do you want me to say it? Yep, auto big freaking bubble. Oh, in cars you mean? Yeah, for sure. Auto loan bubble can pop. Sure. Sure. Sahan, thank you so much for being a part of the trading fam. Welcome. Thanks for your input, Z. Appreciate you guys. Appreciate you, Steven. Grizzly Bull, appreciate you as well. Let's see. This is the last rally before a big crash. Okay, let's see. But sorry if I mispronounced your name. Balas Zabo. Why do you think there will be a big crash? Let me know. James, hi brother, no question for me. Appreciate your work. Appreciate you, James. Respect back to you. Nicki Minaj or Cardi B? In terms of raps or looks, because if you look at Nicki Minaj's like past freestyles, she can rap. Like, she is really dope. If you look at her past ciphers and freestyles, I'm talking about, maybe this is going back like 10 years ago. If you're talking about who I'd rather go to dinner with, Cardi B. What time is GDP coming out tomorrow? That's a good, I think it's coming out at 5:30. It's really early. Let's see. What time is GDP release tomorrow? Very good question. I think it's 5:30 West Coast time. Yeah, so 8:30 a.m. East Coast time. 8:30 a.m. East Coast time, 5:30 a.m. West Coast time. So an hour before the market opens. Very good question, because I should have known this off the top of my head. VIX is down. We still have upcoming events. It's difficult to understand how VIX works. VIX is solely based on S&P 500 options. That's it. So it's based on how much volatility in price people are expecting in the S&P 500 options. So right now, if people are bullish, then you will see the VIX go down. Where do we get the minus 1.6%? Very good question. This is from the Federal Reserve of Atlanta. So the Federal Reserve of Atlanta gave us the 1.6 minus 1.6% reading. I think it was July 19th. Let's see. If I can find it for you. GDP. Federal Reserve GDP tracker. It might, yeah, right here. Oh, they just updated it today. I'm glad we caught this on the stream. So right before today, you could see it was negative 1.6. July 19th was the last reading. Today, we're getting an estimate of negative 1.2. So this right here is our target, negative 1.2. And this might be part of the reason that the market is rallying as well, is because GDP looks to be not as bad as negative 1.6. So tomorrow's official reading, if it's worse, severely worse than this, and this comes from the Federal Reserve Bank of Atlanta, not sure why specifically the Atlanta Bank is the one that's responsible for GDP trackers. There must be a reason for this, but right now it's at negative 1.2%. Still negative, meaning we will still be in a recession. Rob, if you get anything out of this video, please hit that like and subscribe. Yeah, just hit that thumbs up so other people find this. Z, are you bullish on energy stocks? No, not anymore. Dude, stop spamming. Are you still in Portugal? Says Eddie De Brito. Yes, I'm still in Portugal until Friday. I'm in Lisbon. So if you're in Lisbon, hit me up. Hit me up on Instagram. You'll see my Instagram link in the description. So hit me up on there. People, please hit that like button. Wow, James. I mean, I want people to hit the like button, but stop spamming, brother. What guidance did Google give that may be good? What guidance did Google give? Google earnings guidance. Let's see. Whoops. Google has perhaps benefited from, okay, so it actually, Google does not offer guidance. So as I said, Google's likely rising due to sympathy from Microsoft. Also, Google was at a very technical level in terms of support. If you look at Google here, you could see that Google was at the bottom of this channel. Now, there obviously was a chance, because this could be a very bearish pattern, by the way. This could be called a bear flag. And we could have seen a continuation down. You could still see it. I mean, Google can still trade within this channel and eventually break below it, but Google did not give guidance. So only Netflix, Tesla, and Microsoft out of the mega caps gave guidance. Google did not, and it benefits from that, I guess. And remember, the SEC does not require companies to give guidance. It only requires companies to report earnings. So there you go. Hopefully that answers your question. Hello, brother. What's your take on AMC? I mean, trade AMC, based on technicals. For those that think AMC is going to $100,000 or something like that, that's crazy. Trade AMC based on technical levels. That's how I would do it. So, yeah, I don't know. In terms of holding it, no. I mean, to me, it's a stock to trade. Microsoft Play, we already have an iron condor that we need to roll out. Z, can you summarize why we rallied? I just got here. Rewind the tape. Sweat is chick. But yeah, why are you mad that we rallied? Why, I think people need to, don't people get happy when the stock market rallies? The stock market rallied because the FOMC's priced in. Netflix, Tesla, Microsoft gave good guidance. Google did not provide guidance. We still have Meta, Apple, and Amazon. If they're expecting, there might be some sort of expectation that Amazon, Apple, and Meta might give good guidance or at least provide good earnings if the other mega caps did. Yeah, so it's, everything is pretty much priced in up to this point until tomorrow. If the GDP comes in at bigger than minus 1.2%, that might cause a slowdown in the market. If Meta reports negative earnings, negative guidance tonight, that might halt the rally. If Amazon and Apple do the same on Thursday, that might halt the rally as well. Hanzo Hyder, hi Z, I have a crush on you. You guys are too much. All right, thanks all for hitting the like button. I appreciate you, James. I love how he actually reads the chat. I do. It's because I like to see what you guys ask, and I want to answer you guys' questions. Atlanta FDR already predicted negative 1.6. Sir Henry, yes. You might have caught it or not. We just looked at it, and they updated it today to minus 1.2, which is another reason that the stock market is rallying. I hope we get the biggest rug pull tomorrow, says Alvin. I don't know why you were hoping this. Why would you want your portfolio to tank? All right, let's see. The entire SPY gap just filled, wow, on weeks of bad news. What is the bad news? If companies are telling you that throughout the bad news, they're expecting positive guidance, what is the bad news? Think about this logically. The stock market is made up of companies. If companies are telling you that regardless of the bad news, we are going to crush it, why would the stock market keep tanking? Think about it. And so far, obviously, there's a lot of companies that still, have yet to report. Should Pelosi go to Taiwan? Yeah, I think she should, because she's trying to pump her call options on the semiconductors. No, I mean, I think that Taiwan is definitely a strategic, I guess a strategic resource for everyone, because Taiwan has perfected the chip making process to the point where even American chip making companies outsource to TSMC. Even companies like Apple outsource to TSMC. Companies like Samsung outsource to TSMC. So yeah, I mean, I think it's a very valuable resource. Of course, if you're a politician of a major world power, then you're going to want to do everything you can to make sure that that resource is not somehow infringed upon. I mean, it's just common sense, right? I have an itch based upon JP response in the media. It will be negative 1.6 or more. I do think that there is a chance, AT, that it could be severe. Just how quick the White House was to come in and get out ahead of it, right? But remember, it could be the fact that it's negative, because any negative reading, even if it was negative 0.1%, it would be deemed a recession. So who knows? But we'll see. Thoughts on gold? Gold is a terrible hedge against a recession. But I mean, if you hold physical gold, then More power to you. All YouTubers were bearish today. Funny, because we actually bought calls based on the technical levels. I mean, I say it all the time, just wake up neutral and trade the trend. And then some of the analysts in our Discord also sent out call alerts right as JP was speaking. Right before JP was speaking, right? We bought the 305 call. So yeah, I mean, it's wake up neutral and trade the trend. What's your end of year prediction? It depends on a lot of things, man. It depends on earnings. It depends on whether the Fed halts or is more aggressive in September. I personally think they will be very, very dovish in September, meaning less aggressive, because they want influence from politicians in power. They want to win elections in November. And yeah, I think that that they're going to do everything they can to keep the market rallying. Any update on your VIX calls? You could have closed them for 35% yesterday if you weren't holding them as I answered you in the chat in the Discord. Yeah, I said you could have closed them for 35% yesterday if you weren't holding them as a hedge through all of these events, right? Because you have all of these events throughout the week. They were up 35% yesterday. So if it was just a swing for you, you should have closed it yesterday. All right. Any other questions, guys? Any other major questions? What did you do before the YouTube stuff, says Axie? A lot of things. A long time ago, I was actually in the music industry. After that, I taught myself how to code, and then I was in software for a long time. In terms of what my degree was in college, it was finance. And I worked at a brokerage firm for about 6 months out of college, hated it, and then, yeah, jumped to other things. I was in law school, I dropped out of law school, so a ton of stuff. But in terms of my job, I was in software. I was in Silicon Valley for a long time before this. So, yeah. All right, let's see. I don't see any day trade. It's Rakesh. I don't see day trade alert section in the Discord. It's literally right here. I'm looking at it. It's called day trade alerts. Here are the alerts. 11:09 a.m. West Coast time. These were sent. Not sure what you're looking at, brother. Harry Reddy, coding. Yes, started coding and then jumped into management because I saw that the real smart people in software make money by just stepping into meetings and yapping all day. So, Rakesh on my screen, have no idea what you mean. Can tell you spent time in the Bay when you say hella. Oh, well, I am from California. I'm from LA, so yeah. You've had an interesting life. I have. I'm old. So yes, I have had an interesting life. I'm where you at right now? In Lisbon? I mean, I'm from LA, but currently I'm in Lisbon, Portugal. Harry Reddy says. If you're in Lisbon, hit me up, man. Hit me up on Instagram. Why is the market going up? Rewind the tape. Talked about it again. Both massively up. Twitter is trying to break resistance. When did Twitter report? I don't know. All right, guys. So we talked about, did you start deploying your cash? Yeah, I sold a lot of cash secure puts. Are you heavy on dividend stocks? Not really. Meta will rip upward tonight. Maybe, could be or could not be. Coding, want to learn trading. Yeah, I mean, there's a parallel there for sure. All right, guys. So I'm going to end the stream here. I want to thank each and every one of you for joining. If you want access to all of these wonderful trades, check the link in the description and apply to the Traveling Trader Academy. If you guys are here in Lisbon, hit me up on Instagram. You'll see that link in the description as well. But yeah, I missed you guys. I'm glad that the stream worked out, because the stream in New York didn't work out really well since the internet sucked. But this trusty little hotspot has been doing its thing all day right now. So yeah, the rest of you, I will see you in the Discord, and I appreciate you guys for joining. Thank you guys so much. I will talk to you soon. Peace.